Imagine waking up one day to find your bank account with many more zeros. Not just ordinary zeros, but zeros that change your entire life. This isn't a dream, it's a reality within reach. How do some people achieve this wealth? Are they smarter, or do they have secret information? The simple, shocking truth is, they're not smarter, nor do they have secret info. They simply understood the rules of the game: intelligent investing. These rules are summarized in one book, a Bible for investors, The Intelligent Investor, by Benjamin Graham. If you want to unlock these secrets and build real, lasting wealth, this video is for you. Stay tuned, because what I'm about to share will transform your financial thinking forever. In the vast and often bewildering world of finance, where fortunes are made and lost in the blink of an eye, one book stands as a timeless beacon of wisdom: Benjamin Graham's The Intelligent Investor. Published in 1949, this masterpiece is not merely a guide to stock picking. It is a profound philosophical treatise on how to approach the financial markets with rationality, discipline, and a long-term perspective. Graham, often hailed as the father of value investing and the revered mentor of none other than Warren Buffett, distilled decades of experience and rigorous analysis into principles that remain as relevant today as they were over 70 years ago. His core message is simple, yet revolutionary. Treat investing as a business, not a gamble. Understand what you own, buy it at a discount to its true worth, and protect yourself from the market's inherent irrationality. This book is a shield against common pitfalls, a compass guiding you through volatile times, and a blueprint for building enduring wealth. Whether you are a seasoned investor seeking to refine your strategy or a complete novice intimidated by the complexities of the market, Graham's insights offer a clear, actionable framework. It challenges conventional wisdom, debunks popular myths, and empowers you to become a master of your financial destiny rather than a victim of market whims. Join us as we unpack the timeless wisdom of the intelligent investor and discover how its principles can transform your financial journey. Intrinsic value versus market price. All that glitters is not gold. Graham emphasizes the crucial difference between intrinsic value and market price. Many confuse a stock's price with its true worth. Price is what you pay. Intrinsic value is what you get. Like a car, its price doesn't always reflect its true value, condition, efficiency. The same applies to stocks. An intelligent investor distinguishes between a stock's price and its intrinsic value, the company's true worth based on profits, assets, debts, market position, and competitive advantage. An overpriced stock might be a bubble, an undervalued one, an opportunity. Graham advocated value investing, buying stocks whose intrinsic value exceeds their market price. This requires analyzing companies, understanding financials, and evaluating assets' liabilities. It's a disciplined, rational practice based on facts, not rumors. This protects you from risk via a margin of safety. Focus on the company's true value. If strong, profitable, and with a future, its price will eventually reflect its worth. Patience and thorough analysis are key. 2. Margin of safety, your first line of defense for your money. After understanding the difference between price and intrinsic value, we come to the most important principle in Graham's book, the margin of safety. This principle states that you must buy stocks at a price significantly lower than their true intrinsic value. This creates a safety cushion, protecting you from surprises or misjudgments. Imagine building a bridge. You design it to withstand far more than expected weight, creating a safety margin. Similarly, in investing, this margin protects you from errors and unexpected economic shifts. If your analysis estimates a stock's intrinsic value at 100, buying it at 100, buying it at 100, buying it at 50, provides a $50 margin of safety, significantly reducing your risk and increasing profit potential. This margin of safety protects you from mistakes and market fluctuations. The market, like a sea, can be calm or stormy. A strong ship, investment with a large margin of safety, weathers any storm. Intelligent investors buy during market pessimism when prices fall below true value, securing a large margin of safety. Determining the margin of safety depends on your company analysis. The more confident you are in a company's strength and its intrinsic value being higher than its current price, the more comfortable you'll be. Graham urges deep research into the company from all angles. Don't just rush to buy based on stock price. Understand its strengths and weaknesses. When you find a strong company priced well below its value, that's your buying signal. This margin of safety is a mindset. Cautious, long-term investing. It means protecting your capital before seeking returns, distinguishing you from speculators. It ensures peace of mind, knowing your money is secure even amidst market turmoil. 3. Speculation versus investing. The difference between building and gambling. Many associate stock market with speculation, a gamble on price fluctuations. Graham clarifies the vast difference between speculation and investing, a distinction crucial for long-term wealth building versus instant loss. Speculation is short-term buying, selling based on expected price movements, focusing on price, not value. It's a high-risk gamble, often leading to losses. Investing, conversely, centers on a company's intrinsic value. Investors buy stocks because they believe in the company's long-term strength, future, and growth. They analyze profits, management, products, and market position, aiming for long-term wealth, not quick gains. It's like planting a tree, nurturing it, and waiting for it to bear fruit. Graham notes that most financial market transactions are speculation, not investing. People chase rumors and skyrocketing stocks, making the market volatile and causing losses. The intelligent investor understands this and avoids speculation, recognizing it's not a path to sustainable wealth. An intelligent investor follows a clear, disciplined plan, buying and holding stocks long-term until they reach true value or goals are met. Patience is key. Graham likens them to a merchant buying good merchandise cheaply and waiting for market demand, focusing on value over trends. Graham identifies two investor types, defensive and enterprising. Defensive investors prioritize safety, choosing large, stable, profitable companies to preserve capital. Enterprising investors take more risk with smaller, high-growth companies, but always based on deep analysis, not gambling. Graham advises most to be defensive investors, safety first, then profit. Ultimately, choose your path, speculator or investor. For long-term wealth, focus on disciplined investing. If you gamble, accept the risks. Graham illuminates the right path. The choice is yours. 4. Mr. Market, your fickle friend you must exploit. Graham's brilliant analogy compares the market to Mr. Market, a business partner with volatile moods. Every morning, Mr. Market offers to buy or sell shares at a price reflecting his current mood, which changes daily. He might be enthusiastic and offer high prices, or pessimistic and offer low ones. Ordinary investors fall into Mr. Market's trap, buying high when he's enthusiastic and selling low when he's pessimistic, regardless of true value. The intelligent investor, however, understands Mr. Market's irrationality and uses his mood swings to their advantage. Graham advises exploiting Mr. Market. When he's pessimistic, stock prices fall. Buy at discounted prices. When he's optimistic, prices rise. Sell or avoid buying at exaggerated levels. The intelligent investor controls Mr. Market, not the other way around. Don't let emotions drive investment decisions. When the market is fearful, be bold and buy if your analysis confirms strong intrinsic value. When it's optimistic, be cautious and consider selling if prices are exaggerated. Mr. Market offers opportunities to buy cheap and sell dear. Seize them intelligently. This analogy highlights the market's irrationality, driven by emotions like fear and greed. As an intelligent investor, your role is to remain calm, rational, and adhere to your principles, not swayed by market noise. Running counter to the crowd can lead to extraordinary profits. Mr. Market tests your patience and discipline. Mastering him is key to successful investing. 5. Sound analysis and emotional discipline. Your mind is your strongest weapon. Successful investing hinges on two fundamentals: sound company analysis and emotional discipline. It's not about intelligence, secrets, or luck, but understanding the business you invest in. This means examining financial statements, balance sheet, income, cash flow, understanding revenues, expenses, profits, assets, and liabilities. Knowing the management's competence and honesty and the industry's future is crucial for determining intrinsic value and identifying good opportunities. Graham advises against blindly trusting analysts. Do your own research. You don't need to be a financial expert, but understanding basics, reading numbers, and asking the right questions will strengthen your investment decisions. Emotional discipline is investing's toughest challenge. The market fuels greed during rises and fear during falls. Graham stresses that an investor's greatest enemy is their own emotions. Greed and fear can be destructive. An intelligent investor controls emotions. In market hysteria, remain calm and rational, sticking to your plan. If a strong company's price temporarily falls, it's a buying opportunity. If it rises quickly, consider selling or preserving profits, avoiding greed. Graham likens intelligent investors to chess players, strategic, not reactive. They prioritize sustainable long-term gains over quick speculative wins. Emotional discipline, honed by understanding investment principles, is their strongest weapon. The book offers practical tips for investors. Let's review some. Diversification. Don't put all your eggs in one basket. Distribute your investments to reduce risks. Stocks and bonds. A defensive investor divides their portfolio between stocks for growth and bonds for stability. Avoid fast-growing stocks. Focus on stable companies with reasonable prices. Large and stable companies. Invest in companies with a long history and consistent profitability. Competitive advantage and competent management. Look for companies with a strong competitive advantage and honest management. Reinvesting profits. Reinvest profits to grow your wealth through compounding. Avoid market timing. Don't try to predict market movements. Focus on long-term investing and regular buying. Regular investing. Invest a fixed amount regularly to reduce your average purchase cost and risks. Patience and discipline. Investing is a marathon. It requires patience and adherence to your plan, and not being affected by market fluctuations or the opinions of others. All these tips lead to one idea. Successful investing relies on rational thinking, deep analysis, discipline, and patience, not on luck, rumors, or chasing quick gains. Conclusion. Your path to intelligent investing starts here. We conclude our journey with Benjamin Graham's The Intelligent Investor. More than tips, it's a financial philosophy, teaching true investor thinking, not speculative illusions. Real wealth is built with patience, discipline, deep analysis, and emotional detachment. Investing demands effort and study. It's not a quick path to riches, but to sustainable wealth. Graham didn't promise overnight millions, but long-term success and protection from losses if his principles are followed. This book transformed millions of investors, including Warren Buffett, who views Graham as his investment mentor. To seriously begin or correct your investment journey, read, study, and apply this book. Every word and principle holds significant value for your financial life. Now that you know the most important principles of intelligent investing, what will you do? Just watch or take a serious step. I strongly advise reading The Intelligent Investor yourself for more details. For questions, comment below. If you like this video, like, subscribe, and share to help others become intelligent investors. Thank you for watching, and I'll see you in a new video.